You are listening to Seeking the Hidden Thing with Kryptos. Welcome, everyone, to another episode of Seeking the Hidden Thing. And I have on old friends of the pod, Ron Dodson and the Black Horse, and we are here today to talk about something that is obviously on everybody's mind, the problem of distributed corporate ownership. And you are probably thinking, why are we talking about distributed corporate ownership? We're hopefully going to make this matter for you. But Ron, Black Horse, welcome.
It's good to be on.
Thank you for having me. It's always good.
Yeah. It's, this is a subject that deals with financial, the whole aspect of the financial industry. So in talking about this, I know that we have mentioned this and bounced stuff around in chat rooms about this. But Ron is both of you are in the finance industry, let's put it that way, and deal with these kind of realities on a daily basis and even make your living off of it. Maybe to begin with, one of you, and I can jump in because I know from a philosophy, my dad was a corporate accountant in a major chemical firm, and we talked about this. So what's the problem here? Yeah.
So at a basic level, most of corporate America today is organized into very large firms that are, even if they're private, are widely distributed in terms of ownership. The consequence of this, this is something that's gone back a long way. The consequence of this was noted by James Burnham in the Managerial Revolution. But fundamentally, because the owners and the operators of the organization are not the same thing, are not the same people, and because the owners are distributed and therefore disorganized, the organized minority that is the management of the corporation both have divergent interests from the ownership structure and have an organizational advantage to get whatever it is that they want to get done. And so you have a situation where the fiduciary duty that is owed to shareholders is fundamentally vulnerable because of this structure. And so you have corporations that are operated in the interests of the management of the corporation rather than operated in the interests of the ownership of the corporation and maximizing profits. This drives a whole collection of behaviors from corporations that are not predicted by a sort of capitalist lens applied to them. So why does institutional capture occur through DEI? Well, institutional capture occurs through DEI because the ownership class is disorganized and broadly distributed and is subject to these kinds of effectively coups by the concentrated power of the organized management of the organization. So that's kind of reason number one why this is a problem. Reason number two why this is a problem is at a structural level, the United States is decaying into the situation where the outsized ability of very large organizations to raise capital at favorable multiples has created a whole infrastructure where small corporations don't rise up and compete with them. They rise to a certain level and get bought by them. And then get absorbed into the kind of practices that dominate large managerial organizations, not just in the United States, but throughout the collective West, as they say, which prevents the natural kind of business cycle from resetting organizations onto kind of competence-based grounds.
Yeah, and I might add too that that's from the relationship between the managers and the owners and shareholders, but it also affects the relationship between the ownership of the company and the people and places where the work is occurring, so it severs your ties to the locale. So if you have a single owner, business owner, and they're in a community and they, pollute the environment that they live in, well, everybody lives there. If you hire a whole bunch of people and then you close down the factory and you move it overseas, you're staring the people whose jobs you're putting out of work in the face, so to speak. Whereas if your ownership is in New York or spread all over North America in multiple places, nobody cares about the people in the classic example is in Ames, Iowa.
And you're making the argument from a social point of view, but there's
exactly. So that's the other
there's
problem as well.
An argument from a legal point of view. There's nobody. The
organization bearing responsibility
commits a crime. It's 2008
right.
again, and you have a major fraud case. Maybe the management gets held responsible. Maybe, but
does anybody go to jail? You pollute the environment.
Not,
if there's an owner operator who's in charge of the company, even a sizable one, ultimately there's the kind of thing of the buck stops here. But then now with the legal protections for boards and so forth, who are then the voice of the shareholders, is anybody really actually responsible? I mean, there are cases of some managers being held criminally responsible for their organizations, but it doesn't happen that often. Christopher Lash, noted this. Alan Ehrenholt noticed this. So, many let's just say from the social perspective, have noted this already.
Yeah, many people in our space would like to reorganize law to hold the ownership or management of corporations more directly responsible for the actions of those corporations, particularly on the environmental side. That can't happen when you have a broad distributed structure. Because what are you going to do? Put every ETF holder in jail? That's not going to happen.
Well, and not only that, but my dad, I was talking about this with my dad when we were on vacation, and he says, how in the world are you going to raise capital? Like, nobody's going to invest in a company where they can be held criminally responsible for their investments. He says, you're never going to find people to invest because it's too risky.
Well, this is, the philosophical question is does it make social and legal and financial sense for me to want to participate in the profits of an organization? And that in and of itself is fine. The question is, does that equal ownership? And what we've done is we've removed the risk and responsibility from the theoretical decision making. So now, with proxy games and all that there's already problems. But my long-term argument has been that the ability to participate without liability is an option, not ownership, and it should be structured as such. So if you wanted to, and we all know that options and futures, these derivative contracts, do not have decisional authority. My base level is making that if you're not liable, if there's no way to be liable, then you shouldn't have a legal say in the running of the organization.
So let's translate for the audience here for a second. So what Ron is pointing out is that there's a whole suite of financial products, whether they're options, whether they're convertible bonds, whether they're futures, where you can participate in the financial performance of a company without having voting rights or liability associated with the company's performance, right?
Exactly right.
Those products already exist, and there are already mechanisms. I mean, convertible bonds are very common mechanisms for small companies to raise capital.
That's right.
And the argument here is that if you restrict equity ownership to only those people you intend to make liable for the actions of the corporation. There are a whole collection of other vehicles by which you could get participation in the profit stream and therefore the ability to raise capital for large projects. So it's not like restricting equity ownership means that the only people who are ever going to be able to participate in the profits of mining or other large capital intensive projects are going to be people with large pools of capital. There's a whole collection of alternative products that you could offer to help corporations raise capital while formalizing the de facto situation where the actual decision-making power is quite narrow over the corporation.
Would that then not, though, and this is the thing, would that then not still create the moral and social issues between, like, a disconnect between investment and the responsibility for the moral actions of the company in which you're investing? Or is that really then
well, there's
or
layers
is that not
to this question, right?
Sure.
So
yeah.
The first layer is, do you want to prevent scale? And the second layer is, do you want to prevent principal agent problems? And then the third layer is, if you want to prevent principal agent problems, how narrowly do you need to concentrate ownership in order to do so?
Well, and that's, I think, like, from my perspective, I think,
and from your perspective,
scale is a problem.
Scale is a problem.
That's and then issue. The disconnect between and the other disconnects you're talking about are also problems. So, in some sense, I guess, by addressing this question, because I'm a parallelist, I recognize that political scale and economic scale is one of the things that drives many of the problems that we face today. So then, I guess as things, anything that discourages economics and the accumulation of power at scale, at least on the surface, fundamentally seems like a good thing to me. And then maybe you guys can talk about that a little bit. But I think the way you frame it there, though, Black Horse, is absolutely correct, because those are kind of your basic issues: is the problem of scale and the problem of the principal owner, probably, and then the downstream effects of that.
Yeah, I think the issue with addressing the problem of scale is it's both a problem and and the ability to get to scale is also an important solution, right? There's a whole collection of businesses that are integral to our kind of standard of living that require immense scale.
Well, the automobile industry, for instance.
The automobile industry, yes, but smaller scale manufacturing is definitely a thing. You can distribute the supply chain among many different companies. That you could definitely organize that industry differently if you wanted to, but you can't organize. You can't build a hydroelectric dam across a river without it being a certain scale. It's just that's how big the river is, right? You can't build a mine.
Exactly. Yeah.
I mean, potash is like whatever it is, 10,000 feet in the ground for the closest deposits. You need an accumulation of capital of sufficient scale in order to even enter that business.
Even a small scale potash operation is a huge business.
Well, it's a couple of $1 billion to put a hole in the ground.
Yeah. I've seen them recently.
The scale is both a problem because if you have a $3 billion retail operation, you span 6 states, and you've got a big abstraction between that operation and the community. And if you've got a $6 billion mining operation, that abstraction doesn't exist at all. You've got one operation. So it's difficult to kind of measure scale and restrict it. But it's definitely a problem, and it's a problem to kind of be aware of. Equally, it's a problem because the larger the scale of the corporation, the closer and closer you're inching to the owners of the corporation participating in the kind of political oligarchy that runs the state. And so the larger you allow corporate interest to get, the quicker you're getting to a situation where the merchant class forms an oligarchy that dominates the politics of the.
Yeah, let me. Yeah, absolutely. That's a great point. Let me jump in because I was taught. I'm an old guy with gray hair. Not that old, but old enough. I was taught that when everyone owns everything, that's called communism.
Yeah,
And
yeah.
and so I'm just flummoxed that we've gotten to this point. I think the problem of scale, it is an easable. I think that is an achievable hurdle to get past through hybrid instruments. Again, through participatory notes, whatever class you want to set. But if you have voting rights, you must participate in liability. And and yes, does that destroy the massively distributed ETF business? Yes, it does. And I'm great with that. I want to destroy. I think it's fundamentally immoral. Not because distributed ownership is in and of itself bad. It's to the scale that it is that removes to where ownership is basically oligarchic, as Black Horse has pointed, but it's oligarchic in exactly the wrong way, where you get Larry Fink with incredible, not only corporate, but political power, simply because of the number of voting shares that basically he controls.
Well, and I think it's a really important point that he controls them not because he owns them, but because he's in a
Right.
position of management.
Yes,
If he was in a
absolutely.
position of having immense power because he owned all of those assets, then at least he would have some accountability over the actions that he took.
Mhm.
But because he's in a position of management without a position of ownership,
Mhm.
he is both immensely powerful in the position and completely without accountability to the immediate consequences of the actions he takes on behalf of the class of people whose shares he manages.
Right. And to make it more along the lines of what Kryptos is talking about, what all this does is really drives time preference. And high time preference is 100% of the time destructive to civilization. You Whereas if I am a direct owner with liability, I I might have at the highest medium time preference, because I know high time preference increases my legal and operational risk. If everything is about the next quarter or the next month, I know that there are certain pedals being stepped on that aren't good for my long-term wealth. Whereas if it's purely this derivative ownership, which is what I call the Larry Fink thing that you just described, derivatives are not ownership. And I just, it drives me a little crazy. And again, I play in this world. I
Well,
only do derivatives. I do derivative risk
yeah, yeah.
arb, but I have no desire of owning or having a say in any of this stuff. Um, so
So I
I
think
don't know.
we've established the problem at kind of a couple of levels of abstraction. So the first level of abstraction is there's a principal agent problem in any large organization where the shareholding is wide and the management is narrow, and therefore there's a kind of systemic advantage politically within the organization that the managers have.
Yeah.
Then there's the next level of abstraction, which is now your ownership isn't just wide, but your ownership has diversified interests because they've got diversified interests across many organizations that they have small ownership stakes in. So they're even farther in terms of your ability to get accountability, and they've got an investment manager sitting between them and the thing that they hypothetically own a piece of. So you're giving an even greater degree of advantage systemically to both corporate management and investment management in terms of the power to control decision making. So I think there are straightforward solutions to that, and the most obvious is the straightforward solution you propose, which is to restrict the breadth of equity ownership to people participating in liability in the company, and then to use derivative products of various kinds in order to allow for the raising of larger sums of capital.
Yes.
The second problem that we're trying to access here is the problem of absolute scale rather than relative scale. So the problem of distributed ownership is a relative scale problem. There's lots of shareholders. There's a small number of managers. But there's also a problem where even if you've got a single person who owns a company operating in 28 states, their abstraction from the local operations of that company mean that their accountability is only legal. Their accountability is not social.
Yeah.
And that's a problem as well.
This is the federalized problem that we see in government that's in tension both in Canada and in the States, is that interplay between distributed and nationalized responsibility that's kind of coming to bear. What are the concerns? My wife is from New Brunswick. Does New Brunswick share all the same concerns as Alberta or BC? Does Texas share all the concerns with Montana or Maine? And the answer is yes and no. And
I think at a basic level, the first problem there exists an actual solution to. We can actually make owners responsible for their organizations and give them give them an incentive structure that will change the way they interface with management. The problem of scale and localization is a situation where there are no solutions, there are only trade-offs. So that large organization operating in 28 states is going to have less interest in any of the given local communities than an organization concentrated in a single state, a single town, a single neighborhood. However, they're going to have advantages of scale in operating the business. And there's also something to be said for the fact that restricting the size of a business operation is a kind of negative incentive toward excellence. So in some sense, if somebody runs Walmart so well that they can scale up from one store to 50,000, they deserve to be rewarded for that. And there's real value to society in having some reward in that scale up. So in my view, the problem of absolute scale, once you've restricted ownership, is a situation where you've got a trade-off between the value of aligning their incentive with the local community and the value of aligning their incentive to do the very best that they can. And I don't think there's a solution to that problem. I just think we've got the slider at the extreme end of, do whatever the hell you want, wherever the hell you want it.
Right.
And there's only trade-offs, so you can move that slider around. But nobody should move that slider around without realizing there's going to be real costs.
Well, profit becomes its own morality.
Well, yeah, Nick Land talks about this in the hyperliquidity of capital is always going to chase that without any financial borders.
Yeah.
And you can set them up even, in the States, we have this uniform commercial code that was born out of the Commerce Clause and so on and so forth, to where you have the hyper liquidity of capital, to where state boundaries really don't matter, which were originally part of this safety mechanism, Black Horse. Yeah. And I don't know the history as much in the provincial system.
Well, in Canada, we have this big, long-standing argument about how there are, quote-unquote, interprovincial barriers to trade, which comes down to the fact that provincial barriers in Canada are actually a lot more meaningful than state barriers in the US for doing business.
Right.
And the consequence of that is that it is hard to do business in every province in Canada. Our business interests tend to be a little bit more localized, especially outside of certain businesses like retail,
right,
where you can kind of use a franchise model to get around it a little bit.
Right. And franchise, the franchise model puts owners on boots on the ground, that, I mean,
yeah, the franchise model is a compromise on scale versus locality.
Right.
But my basic view is you can raise the barriers to doing business across provincial or state borders, or even like I would love to start by raising the barriers to doing business across national borders.
Sure.
And if you're a U.S. company, you have to actually do your business operations in the U.S.
Yes. Yeah. Well, I think you're exactly right. I want to keep going on these critical infrastructure type. You mentioned a dam. I think of nuclear power in the United States, and the problems of raising capital at that kind of scale. I mean, ultimately, you can't. I think there are ways that you can deal with that, but it all gets down to you have to have wise and a wise aristocracy and a wise ruling class in order to judge those. And you can't get away from that. If you want to just managerialize, if you want to, make Talmudic all the rules that govern this throughout time, you're going to get into trouble because there are no rules that fix everything among all dimensions across all timetables, right?
Well, I also think skin in the game has a much better track record than rules, right?
Absolutely. And that's what we're getting at, right? That's the whole point of this talk is skin in the game is somewhat self-governing. That there are incentives baked into that prevent some of the issues that that you guys are dealing with up north and we're dealing with down here.
Well, skin in the game also evolves with the changing environment, right? So, my favorite example of this is the Jones Act, which is a law in the U.S. that dates back to the early 19th century. The maritime business has evolved enormously over the last 200 years, just completely transformed. And yet this piece of legislation continues to exist. And my point of view is that explain
the Jones Act. Explain, because people that we're talking about stuff. I mean, I know what you're talking about, but most folks are there. There's question marks forming over their heads right now. So explain that, Black Horse.
Yeah, I'm not a deep expert in the Jones Act, but it regulates the way that you have to stop. If you stop at a U.S. port, you have to have a certain fraction of the vessel built in the U.S.
That's right.
And there's a set of rules.
It's a high fraction. It's not a small thing.
What exactly that means. And what it does is it causes people to skirt around stopping at U.S. ports because vessels built in the U.S. are more expensive than vessels not built in the U.S. That act probably made a lot of sense in the 19th century, the early 19th century when it was passed, when most shipping done in the U.S. was between two U.S. ports. Most shipping today is not between two U.S. ports. It's between a U.S. port and an international port. And so the Jones Act is a grievance for every trade partner in the United States because it's an effective subsidy to the U.S. shipping industry that's not that's going to be a sticking point in that trade agreement. You can think that's good, that's bad, that's indifferent. The point is the consequences of this piece of legislation have evolved tremendously over its lifetime. And the piece of legislation says what it says. It hasn't really evolved as the situation has evolved. Laws that drive skin in the game evolve as the industry evolves, because all you've done is you've changed incentives. You haven't actually said how you have to meet that incentive. So if you have to localize your business, if you have to operate within a single state, if you have to operate within a single country, that's a law that is going to naturally evolve as the history of that country evolves. And is not going to have to be constantly maintained by an army of bureaucrats trying to decide how to align incentives in the future. if you wanted to have a working version of the Jones Act, you would need a mountain of experts who understood the shipping industry to decide what the best way to manage the Jones Act would be, in 2010, in 1980, in 1930, and 1870. Whereas laws that simply align incentives, they're ever ripe,
Exactly.
Well, it's almost like the analogy for the average listener would be something along the lines of setting up, say, a NASCAR, like a racing car, or a Formula One car. The whole thing of like rubber racing, and if you're not cheating, you're not trying. There is a sense where on the one scale, like on the side of scale, you could have a society in which everybody is completely moral and all of their financial dealings are restrained by a high sense of virtue. And then in this case, you probably aren't worrying and we're not having this conversation. On the other side is where capital is completely determinative. So making profit creates its own morality. As long as it creates money and it makes money, it's thereby good, right? And that's sort of the other scale, the other end of the scale, and sort of the profit mode. Somewhere in between, there's rules.
Positivism.
Yeah, there's rules, right? And so, okay, running NASCARs at 260 miles an hour, you can build a NASCAR that runs at 260 miles an hour, but people die in those situations. So, you want to restrain how fast these cars are going. And of course, people who want to win races want to push the limits of how fast they can make cars go, at least faster than their opponents, right? And so I don't think you're going to get away from the legislative problem. I think that, like what Black Horse is talking about, this idea, if you have a piece of legislation that doesn't adapt, everybody who is going to be making money has already figured out all the ways that they can get around, and it becomes irrelevant. So you're going to have to almost,
the other thing,
as we talked about with technology, can you even keep up really? But maybe you can't keep up, but at least you can try.
But it also creates an opportunity for this army of, busybodies to update that law.
Yes.
Right. So if you look at the Securities and Exchange Law Act of 1934, there's like 500,000 people employed in the United States, at least, to comply with the Securities and Exchange Act of 1934.
Securities and Exchange Law. I mean, you can make good money doing it.
And, law, and not only to comply with it, but to update it for every new product that comes out and blah, blah, blah. In order to avoid creating this situation where you get an army of these parasites, what you want to be doing is you want to be creating a legal framework that aligns incentives so that you don't have to have laws, right? We know that people need to be governed. The issue is, how do you govern them without creating this army of compliance officers everywhere? Well, in order to govern them without having an army of compliance officers, you align their interests with the interests of the community. And so, as I say, this set of problems of scale and locational diversity, there's no solutions, there's only trade-offs. In the same way, but on the issue of laws which are enforced by monitoring and laws which are enforced by an alignment of interests, there actually is solutions, right? It actually is just stupid that instead of holding the owners of corporations liable for the harm they inflict, we have, the EPA chasing them around to figure out whether or not they're putting, whatever in the water table. Instead, enforcement by punishment is a lot more effective, and it's got this like 5,000 year history in our society of working. Whereas enforcement by like busybody agencies has, this very short and not particularly successful history.
Well, and not only that, but it also undermines society in the long term. It's the kind of thing that Joseph Tainter talks about in terms of, the accumulated weight of managing complexity, right? So the idea is always to be striving for simplicity in your solutions. And maybe one thing just to maybe loop back, because the audience may not be, understand in some sense what Ron was talking about. Like, I think people get the idea that you as a business owner go to the bank and you borrow money and then you have to pay it back. That's on one level of financing. People, I think, understand a venture capitalist. You go to a guy who's got a lot of money and then he lends you money, but part of the process is now he owns a part of your business, right? And that's kind of the way that some venture capital works or whatever. And then the other is, like distributed stocks. So you then say, hey, you go to the market and you say, I'm going to create 10,000 shares. Everybody owns one share. The price is going to be $25 a share. And then you sell the 10,000 shares and you raise a whole bunch of money, but now ownership is distributed right across this sort of thing. But Ron is talking about a whole different sort of thing in terms of derivative ownerships. And maybe for the benefit of those who aren't part of the financial industry, Ron, explain what you mean about sort of alternative financing that then can help maybe allow a balance between legal responsibility and funding, and maybe get past this idea that necessarily all businesses have to necessarily scale up in order to raise funds through things like, IPOs, share releases, and so forth, that you're obligated to basically scale up at a certain point if you want to raise capital.
Yeah, and I apologize for my audio because my my microphone just cut out for some reason. But
that's fine.
Okay, so first of all, I think what Blackhorse alluded to at the very first was is debt structures that convert to equity at some point. That type of derivative instrument, in other words, and by derivative, we just mean something that derives its value from something else. Okay, chiefly earnings is what we're talking about. But if I'm coming at this from and my perspective is driven by my participation in the derivatives, the options market for 30 something years now, and options, the option to participate doesn't have an ownership aspect to it. An option like a call option. So you have if your equity is trading at $100 and you have a call option at 120, you begin to then the value of that option goes up as the value of the equity goes up, and so on and so forth. I think most people have some level of understanding of that. But that option, while it is an option, does not convey ownership or authority. It is a future participation, and one of the chief aspects of that option is a time limit. It's like the inverse of an insurance contract. So if I'm driving my car, I have to have that insured. That insurance contract lasts either 6 months or a year in the States. Well, the opposite of that is something that conveys this participation, but it has to be limited in time. And I think that's where this should all, in my opinion, and I don't have all the answers, I really don't, but I think the conversation is necessary, that's where that optional ownership, that this derivative participation has to be limited in time. And that time may be 5 or 10 years. Most, a private equity position is normally a 5 to 10 year kind of participatory time horizon. So even debt instruments in multifamily, my family business that I helped run for years and years was in multifamily, and we always did 5 to 10 year debt instruments on those, not 30-year, because there was a limited time frame into which we wanted to participate in this particular thing. And I think that's whereas this open-ended infinite regression of share prices that assumes that earnings are going to be forever. First of all, that's a flawed assumption. They aren't ever. There's very few companies that last forever. Most companies go out of business at some point, even the ones that eventually make, say, the S&P 500.
Okay, so I think there's actually an important point that you're getting at here. So for those who aren't daily participants in the market, they may not be aware that when you value a piece of equity at present, there are two broad categories of what you're valuing is the future earnings of the company. And in the sort of 1980 textbook version of this, you imagine that all of the profits of the company are eventually going to be paid out to shareholders either by share buyouts or by dividends. And so you value all of those future earnings compared to a debt instrument, and that's how you come up with the value of the corporation. What's happened in the last 10, 15 years is that because of the way the tax code works, companies have stopped returning equity to their shareholders. And so you have this valuation based on an almost infinite future where these companies think they're going to return capital. You know, Amazon is a good example of this. They avoid booking profits in order to avoid paying corporate taxes, and yet their share price isn't zero because of this infinite time horizon concept, right? Whereas from a social point of view, that profit incentive is extremely important in order to control malinvestment. So a company like Amazon can run Amazon Prime at this enormous loss for a long period of time, bury it inside their books, and not have it come back to the board with consequences because of the way that this structure works. So
because they can maintain liquidity. Like, so the cash flow is always moving. And so because nothing ever has to stop and they never have to give account, as long as they can maintain liquidity, they can run at zero or negative profits indefinitely. And the value can keep going up all the time.
And the consequences to that are tremendously negative for society at large, even if it's good for the shareholders in a kind of narrow sense. So that's a separate category problem.
Just real quick, I got to run. Real life is calling. Helping my kids move today, and I got to run. So I apologize, but this is very. I can't wait to listen to the rest of this. And I'll see you guys
Dad, where are you?
Yeah, I think
I'm in Austin, where my kids are in college, and I'm helping them move today.
So there you go. And they're wondering where you are. You're supposed to be schlepping furniture right now.
I am supposed to be schlepping furniture with my 58-year-old shoulders. So I'll see you boys. This is really good. And I'll talk to you soon.
All right. Thanks for showing up, Ron. Yeah.
So I think the last thing we should do on this podcast is go through a hypothetical of the options for financing a large project and what the consequences are in terms of trade-offs along the lines we've discussed.
Sure, and maybe even some of the regulatory things that can be done to ameliorate some of the problems of scale. But yeah, go ahead.
Yeah. So hypothetically, we've got a dam or a nuclear power plant, some capital-intensive local project that has to be done. There's kind of the first option, how it's done today, is the government partners with some corporation that owns 48 others of these projects and puts it into a portfolio. In that circumstance, the incentives of the managers, the incentives of the owners, and the incentives of the state are all misaligned. Nobody has any real ownership over the consequences of the project, and nobody is really accountable. So that's a worst case scenario. That's where we are now. If we talk about some of the alternative options that we've discussed here today, the first thing that we would do is we would say, okay, it's illegal to operate across state lines for a company that makes dams. So you're going to have to hire people. You're going to have to bring them to Montana, and all of your employees are going to have to physically be here and participate in the consequences of this. So you, as partners who want to do this, are going to hire these people in from elsewhere. You're going to bring them in for term contracts to do that. Then you're going to have to raise the capital required to build the dam, both to hire the people and to do the construction project. So you're going to have however much capital comes from the partners. Maybe you've got 10 partners who are the core of the project who are going to participate in equity. You're then going to offer either the government or the public or whoever is going to finance this one of a couple of choices. There's the debt financing route where they're going to loan you money and they're going to have some interest in your success because your ability to repay the loan is going to be predicated on the success of the project. So that's one route you can go down,
or at least pay the interest on the loan.
Exactly. The problem with that is people are not going to be very willing to loan you money without any control over the project. It's going to rest on your personal credibility to execute. And so it's going to make financing very difficult. Yeah. The next kind of layer of complexity is, okay, so maybe I can't get debt financing from a bank. So what I'm going to do is I'm going to use one of a couple of products. Ron talked about the option route, which is you get an option to participate in the future profits of the dam. So if the dam, you're in for $100. If the dam succeeds, it'll pay you back 120, 150, whatever, based on the profitability of the dam in the future. And there's a 10-year term, and it expires worthless if the project is unsuccessful. You don't get a say, but you get to participate in the profits, and so your incentives are aligned elegantly with the people, with the partners. The third option, and you could do that with an options contract, you could do that with a futures contract, you could do it with a contract for difference. There's a lot of existing financial structures through which you could do that if you wanted to. There's option number 3, which is a convertible bond, which is a hybrid instrument between debt and equity. And that says there's some portion of this financing, which is debt that you got to give, that the partners are going to have to pay me whether this succeeds or fails. And there's some portion of the project that's going to pay out conditionally on the success and future profitability of the project. And the advantage to that is it both aligns incentives and it is more attractive to investors because there's some level of guaranteed return. So this is the instrument most common for junior finance right at the moment that's not an equity instrument. All of these instruments are entirely compatible with a world where those 10 partners are personally legally liable for the consequences of what they do. So if they build a dam and it fails and it kills all the people downstream, you can create a world in which they go to jail for the rest of their life or are hung or whatever.
Hang in the town square or something. Yeah,
exactly. So you have 3 kinds of instruments available to you situationally that allow you to both raise capital to meet scale, while at the same time enforcing liability on a narrow partnership group, and are compatible with because you're not a slave. You can have workers cross state lines, are compatible with putting borders around capital to align the interest of capital and the jurisdiction in which capital is operating.
Yeah, the social problem. Yeah.
So those are kind of the tools that exist, and as we say, on the alignment of incentives, this is really just a straightforward. It will be bad for people in the industry of raising capital today if rules are changed in this way. But from a social point of view, there is no argument that says that the current situation is better in any way than a restricted ownership situation.
Well, and even too with a kind of command and control single owner or multiple owners who have skin in the game, you can still scale up, as you've noted, to quite a significant level. I mean, look at what Sam Walton did with Walmart, and there was a lot of these privately owned companies. I mean, now they have managers that manage it for them, but they're privately owned.
Henry Ford made whether it's Standard Oil or Henry Ford, all these people in the Gilded Age had tightly held businesses.
And they were fairly sizable.
That scaled up enormously. So this is kind of independent from the second problem, where there aren't solutions. There are only trade-offs for the second problem.
There are. Well, and with the social thing, you'd have to realize that the more that you want to connect capital to the communities, as you say, in which it's operating, that does limit scale. Now, the positive, like people talk a lot today, especially you get the whole dialogue between left and right is one of these things over income inequality. Well, income inequality is exacerbated, the larger the pyramid that you have, as you spread out the base of the pyramid, and then you can build a taller and taller pyramid. So as things scale up, the top of the pyramid becomes farther and farther from the bottom as it grows. And that's one of the reasons why it grows in size. And that's also why today when businesses can scale up to a global level, the inequality between the top and the bottom becomes grotesque. And so there is a certain, from a social incentive, rather than say doing, welfare extraction and so forth, these types of things, of just simply limiting scale and the size of the pyramid. So now the trade-off is that you have
tremendous benefits to limiting scale.
Yes, and there are some trade-offs though.
From the point of view of aligning incentives, from the point of view of suppressing the merchant class and politically, there's like a whole collection of benefits that you can realize, but it's a trade-off slider. The more you limit scale, the less the total prosperity of the system is likely to be.
That's right.
At least,
and that's not to say, that the system isn't prosperous. And I've talked about this with Nick, but he says, too. So, like you say, okay, yes, you descale, and maybe you can't, make things in China anymore cheaply, but some of the social benefits you get for having a slightly lower standard of living, or maybe not slightly, maybe a 25% drop in standard of living, is that your overall quality of life is better. And so that it really comes down to, in a sense, of it define, like what are the end goals of an economic community?
There's also the issue of the long-term human capital consequences, right? Because it's more efficient today to make clothes in Vietnam doesn't mean that over the 100-year period that's good economic strategy. So there's a trade-off slider between maximizing the efficiency of the production system right now today and maximizing the long-term health of the body politic. And I just think we've talked about some of the mechanisms you might use to move the trade-off slider. But there's two comments I want to make before I leave this. First, the trade-off slider is right now, as far as possible, in favor of immediate efficiency.
Yes.
And so
short-term gains and profits.
I think it's pretty reasonable to think that it would be a good idea to move the slider a little bit away from that end. How far you want to go is an open discussion, but I think we're all the way at one end now. Maybe that's a little extreme. The other comment that I want to make is that if you look at the actual problems that particularly Americans have today, I would rate not having enough material possessions very, very low on that list of problems, right? Not being able to buy enough gym shorts, that's not a problem for that ranks.
The tell there is how many television shows are there on decluttering and so forth, right?
Yeah. So I don't think if you objectively evaluate American life, even Canadian life to a somewhat lesser extent, the problem of not having enough stuff is really that's not our problem. We should trade having stuff for solving some of these other social problems.
Yes. And be willing to do that. But again, too, it becomes down to kind of a mania of social incentives. We have been told that all of our needs can be solved materially. And so there's a very big shift that has to occur to say, hey, everything should be smaller, more human. And, it probably wouldn't be a terrible thing if overall society was a little less prosperous, if the prosperity that we do have is located closer to home and has a moral responsibility attached to it.
Yeah. And so like at a very basic level, the choices that have been made in the 20th century to make the short-term material value of consumer goods, the ultimate end of how society is run, has led us to this position of placing the slider where it is. In order to move the slider, you have to reorient the fundamental values of society. At this podcast, that's what we're talking about. If you reorient the fundamental values of society in a healthier direction, then you can justify moving this slider and getting everybody to a better place.
Well, yeah, and like the most recent example for me is in my cross Canada car expedition that I took with my wife and parents this summer. But when, having a lot of this stuff bouncing around in the back of my head, and, the divide in Canada, which is a particular example between the Laurentian elites in Ontario and Quebec and the Alberta elites in, the prairie provinces, is that, waking up in a town and just crossing the prairies and seeing, as you see, the potash mines, staying in a town like Lethbridge, where all of the businesses are oriented around agriculture. And you realize that there's a whole bunch of businesses here that have no connection at all to Ontario and Quebec. And from these businesses, there emerges a political power that isn't dependent upon the people in Ontario and Quebec and Ottawa. And they want a meaningful seat at the table. So if you think about it, say, in terms of American context, when you're run by these large corporations that are multinational or even just national,
when you move that slider, you affect where political power is locus.
That's exactly the point I was going to make. So if you want to return power to, say, to Texas or Louisiana or Mississippi or to Wyoming, to do that, you would then have to move economic activity and, as you say, move that slider back to a point where if you live in Mississippi, the vast majority of economic activity that occurs in Mississippi, the ownership is there, it originates there, and if possible, the financing is there, the labor's there. And from that, a Mississippi political elite can emerge.
Let's make a hypothetical change, which would be very extreme.
Sure.
So you're not allowed to own any businesses operating outside your state. What's the consequence of that? Well, the consequences of that are immense. People will move around, businesses will fragment, you'll end up with just a vastly different society. But one of the things that you will end up with is powerful political interests located in every state in the union. Right.
And then strangely enough, federalism will work.
Exactly. And so people will look at this podcast and say, this is a boring technical topic, but the political solutions that people seem interested in are fundamentally unstable without addressing it.
That's exactly the point. And also, and not only the political problems, but many of the social problems that we have,
they're intractable,
also requiring us to address this issue.
Yeah.
Because without doing, and so these are kind of things, and this is why the problem of distributed ownership, why, having the New York Stock Exchange is undermining your political sovereignty in Alabama. And
absolutely. Until
you understand that, you're never going to be able to deal with the political and social problems of the relationship between the federal government and the states.
Yeah. Okay, we're running up on time. Is there anything else we need to get to before we go?
No, I think that's good. Thank you. And sorry, Ron had to bail. And as he said, he's helping his daughters move into college today. And they were on the phone with him, wondering where he was. And so he had to go and show up. And as we said, schlep furniture. So anyways, Black Horse, thank you for coming out. And maybe just before we go, where can people find you if they don't know already?
Yeah, so people can find my work on Twitter at the Black Horse 65 or on Substack at the Red Ensign. I've got a YouTube channel of the same name. The Red Ensign project is really a Canada-focused project, whereas on Twitter you'll find some of my more broadly oriented work.
Very good. Again, thank you all for listening, and have a blessed day.